This is Chapter 9 of the International Relations course, looking at global finance. We've already looked at globalization in general, as well as the system of trade. Looking back to 1944, which is where we have the formation of the modern global economic system, when the World Bank and the International Monetary Fund were created at the Bretton Woods Conference in New Hampshire. The monetary exchange system was based on the U.S. dollar backed by gold at that time. But in '69, the special drawing rights was created as the global currency that was monitored by the International Monetary Fund. In 1971, because of the volatility of the financial system, as well as the flexibility that this allowed for, the United States abandoned the fixed exchange rate and the dollars linked to gold. So we'll talk about that here in a few minutes of how that generally works. The financial systems are linked, interconnected throughout the world, so that's why when a major country such as the United States has a financial crisis, it could tend to be a global crisis. The U.S. subprime mortgage debt bubble, which facilitated the Great Recession in 2008, also led to a global banking crisis where the stock markets throughout the world tumbled. And the slowdown of China's economy, which was growing at a fairly consistent rate of around 8% per year, very difficult to keep that up indefinitely, and the slowdown of China's economy also has global ramifications in terms of other countries' finances, GDPs around the world. The ripple effect also created a debt crisis in Europe. Let's talk a little bit about the international currency market. These are the exchange rates currently. $1 equates to about 0.8 British pound, about 0.1 or 0.91 per euro. $1 here is equivalent to about 7.04 Chinese yuan, the Chinese currency. So what that means is that $1 can be exchanged to buy 7.04 yuan worth of Chinese goods. And this is actually up over the past year from around 6.72 yuan per dollar. And that means that a year ago, $1 could buy 6.72 yuan worth of goods. Now it can buy 7.04 yuan worth of goods, so we can actually buy more Chinese products for our dollar, which means that makes Chinese imports more attractive. And that's actually the opposite of what the Trump administration was wanting to do. They were wanting to swap that the other way. So that shows you how difficult it is to do that on the global market. So in a nutshell, what this means, if the exchange rate were to go down to $1 per 6 yuan, that means it depreciates relative to the yuan. The U.S. dollar would then buy less Chinese goods. Thus, there would be less interest in that case in Chinese imports, and conversely, U.S. exports to China would then be more attractive. So putting this in the terms of strong versus weak dollar, strong dollar is when the U.S. dollar rises or appreciates relative to the other currency, and that makes imports more affordable. We can buy more imports for our dollar, which is what it's been doing, makes exports less competitive. On the other side of that, when the U.S. dollar decreases or depreciates relative to other currencies, that makes exports more competitive. In other words, our goods are cheaper looking from the other country's point of view. So that makes imports on our side less affordable. So that's it in a very general sense as far as the currency market goes. The fixed exchange rates required the state's monetary policies to maintain them. So that took a lot of effort with foreign reserves and buying and selling of currencies in order to keep that exchange rate at that particular level. Floating exchange rates are now the most common, to where the market, the supply and demand of the currency market, is what's determining what those prices are. And these values have changed barely a fraction in the last 6 months. So that shows you how slowly that these exchange rates would typically move, even though they are floating exchange rates. The currency market out there in the world it's probably closer to $6 trillion now, spent every day in currency markets, buying and selling currencies in large volume in order to try to take advantage of these small differences in prices as they fluctuate. Even we're talking hundreds and thousands of a cent fluctuations, in order to try to capitalize on that by buying and selling in large volumes, called arbitrage. So a lot of money is changing hands every day in these currency markets. What we have more likely, though, is what is called a managed float, where states try to intervene when they can to manipulate the value. China has been able to do that more easily than most other countries because of the incredible amount of foreign reserves that they have. So they're using those currency reserves to buy or sell U.S. dollars, or to buy or sell yuan, whatever it takes, in order to keep their exchange rate high to where their products are cheaper to us, so that it continues to motivate us to import, to buy their products. Now, when it comes to the state's control of these currency markets, and we'll talk about the Federal Reserve here in a minute, because these federal banks, Federal Reserve banks, are targeted with a lot of conspiracy theories, but the states, in reality, control only a fraction of the entire currency market. States do not have the amount of currencies or the ability, the flexibility to be able to do much with that in their particular realm. But the Chinese, as I said, because of the amount of reserves that they have, they can hold that artificially high in order to make imports cheaper to us, as I showed in that previous example. In the short term, currencies are affected by this speculation that I talked about, this massive buying and selling. But even so, as I said a few minutes ago, when I updated those currency exchange rates, not a whole lot of fluctuation over the past 6 months. Long-term supply and demand of these currencies, and that has to do with political stability, your own economic system, how much other countries put faith in your system that makes your particular currency valuable, worth buying and selling. So those are the things that drive the long term, which is the supply and demand of your currency. Buyers would go out there and purchase more of your currency, therefore raising its price. The low value does promote exports, and that's why it's tempting for some countries to devalue your currency in order to make your products cheaper to other people, and therefore hopefully pick up your exports that you can sell to other countries. That could be a tempting quick fix for some financial problems, to perhaps try to boost your exports by devaluing your currency. In 2006, Russia devalued the ruble 6 times after the price of oil plummeted. Now, as we'll see later on, there is a risk to doing that, because if you devalue your currency, then other products from other countries that you might depend on are going to be more expensive, and that could affect your import market as far as getting products that you might really need. And that could literally, by doing something like this to hopefully try to boost your exports, you could actually hurt your economy. Inflation is a term where prices are increasing over time. This is fairly normal. We try to keep this at a relatively manageable rate. Even since the Great Recession, inflation was extremely low, and even with low interest rates, it stayed fairly low. And then over time, it eventually kind of bumped up to close to around 2%, which is a fairly manageable level of your inflation. But High inflation is very destructive. That's why these central banks, these Federal Reserves throughout the world are quite united in trying to keep a check on high inflation, because what that means, your money is just losing value the more that inflation rate goes up. It takes more money to buy fewer goods, and the savings that you may have in the bank, they are worth less and less and less as inflation goes up. And as I've said, the industrialized states have been very focused on keeping inflation low. And looking at the table 9.1 in the book, even the global south, which is the generally poorer countries in the world, have also worked fairly hard to lower their inflation rates over the past few decades. So that's become more of a common goal across capitalist democracies, is to guard against high inflation. Central banks, or in the United States case, it's called the Federal Reserve. They are in charge of what we call the monetary policy of the state, and that's basically the flow of money in and out of the system, and they regulate that through interest rates primarily. Congress is charged with the fiscal policy, which we won't be talking about here, since we're talking about global finance, central banks. What the Federal Reserve is a stockpile of the currency. And the central bank then has the ability to loan that money out to its member banks to make sure that the banks have their supply of money. So the central bank customers are private banks, not individuals. However, in the recent crisis that we're facing right now, there are some provisions out on the table to let the Federal Reserve actually loan out to private corporations or private individuals. But generally, under normal circumstances, it's the private banks of the country that are part of this Federal Reserve system, and that's the central bank's customers, or those private banks that can borrow between each other, and the Federal Reserve is the institution that sets those interest rates that banks borrow with each other, as well as the central interest rate that affects the private interest rates. Central banks tend to be autonomous, fairly independent for a reason. They are appointed, in the United States in particular, the governors of the central bank are appointed by the president for 4-year terms. At least that's the chairman has 4-year terms and can get reappointed every 4 years. The bottom line is that once they're appointed, they have quite a bit of autonomy because they are focusing on the economy regardless of the political winds that could be blowing around them. They are appointed to run the bank in the national interest rather than in some political party's interest. Central bankers, led by economists, are going to be able to focus on things like inflation, because not having to worry about being reelected, they can make the tough decisions which elected politicians are going to be less willing to make in order to control inflation, which would also require a little bit more economic expertise to do that. But there is generally a trade-off between inflation and unemployment, and if it was up to a politician, he would more than likely focus on unemployment more so than inflation. And by doing so, could run the risk of letting the inflation get up too high or get out of hand because they're focusing on unemployment. So there's very logical reasons why the Federal Reserve, these central banks, are relatively autonomous. What are their basic functions? I already mentioned that central bank sets the interest rates. These are the loans that they give to private banks, and that's how the central bank generates its revenue. The Federal Reserve, over the past several years, has returned quite a hefty profit back to the government by running the banking system and charging the interest on these loans to banks, as well as what they call the federal funds rate, the loans between banks, in order so that they can have each day they have to have the required number of reserves in their bank. So they're loaning between each other on a daily basis to make sure they have the required number of reserves that the central bank requires for them to have. And the primary discount rate is the base rate that banks borrow from the central bank, and so therefore that sets their rates that they can give to you and me for our basic loans for your car and for your house. Now, lowering the rate would be a tactic that the federal bank could use to try to stimulate a sluggish economy, because by lowering interest rates, that means it costs less to borrow money. So therefore, you might motivate people to borrow money and therefore go out and spend it, borrow that money to go get a car or whatever, borrow money to build a new wing onto your little business and hire more people. So that's the idea. If we lower interest rates, we will hopefully stimulate the economy. And if the economy starts to heat up to where we may be overproducing, might even be at the risk of supply outracing demand, and then prices are going up because of the activity, well, then they would want to guard against inflation, and then they could do that by raising the rates back up to demotivate somewhat borrowing and try to slow the economy down a little bit. And that's very difficult to do. We've seen over the past couple of decades how meticulous that process is, where the central bank is wondering whether or not should we go ahead and start raising interest rates up. We don't want to raise them up too quick. We don't want to raise them up too high. So that's a constant battle. And now that we are perhaps facing a recession now, we're going to be lowering interest rates back again. So therefore, if the central bank had not been progressively raising interest rates up over the past decade, then they would have not had that tool available to them. If we're seeing a recession right now, then they're going to want to start lowering those rates back down. That's why it's a very delicate operation to move those up and down as needed, so that you can actually have that as an effective tool to help your economy. Another thing they do by increasing or decreasing the money supply out there is buying and selling of securities. And these are simply just notes, IOUs, that, for example, if we are in a sluggish economy and they wanted to stimulate the economy, what they would do would be buying securities from the banks, which technically means they are putting additional reserves into the bank's vaults in return for this security. So that is literally getting more money out there into the system. And then if they wanted to slow down an overheating economy, then they would sell those securities back to the bank and take those reserves back out of the bank if they were wanting to slow down an overheating economy. So this is the central bank is already geared up right this minute as we speak to start buying bonds, buying securities in order to try to keep that money flow out there into the country in anticipation of what we might be in a recession. Central banks, as I said, control only a very small share of the world's money, and even though the Federal Reserve is quite a big target for conspiracy theories, that it's pulling the strings behind the scenes and running the evil conspiratorial global economy, well, no, it doesn't work that way. They only have a small share of the world money, and they have to be very meticulous in each of these processes that they do that I've just talked about in order to try to regulate the monetary policy in the country. Let's talk about foreign direct investment some more, FDI. We've introduced that on a previous chapter, and this is the actual hard capital investment that these multinational corporations are doing in a foreign country. For example, Walmart, Microsoft, Google, Apple, Facebook, they are all American countries, but they go out and invest with factories, property, offices, equipment, hiring of people. They go out and do that in other countries. That's called foreign direct investment. These other countries, particularly the poorer countries, are thirsty for that. They need that in order to help their economies develop. We want Google to build a factory here. We want Facebook to build something here, hire people here. However, about 2/3 of all the foreign direct investment in the world is invested in other developed countries because that's where the best investments are. The biggest senders of direct investment are the corporations in the United States, UK, Germany, and Japan. So that's kind of how it works. The 52 poorest countries in the world that perhaps need this foreign direct investment more so than anybody else, they receive only about 2% of all the global foreign direct investment inflows. More on FDI. The host country is the country that wants the multinational in their borders to invest in them, to hire people. They have the power to regulate the multinational corporation in their borders, but they don't want to chase them off. So they offer a variety of incentives such as less taxation or regulation, lower rates to lease land or mineral rights, for example, to provide them the infrastructure that they need, whether it's roads, electric grid, internet, clean water, whatever that multinational needs to come into their country and operate to stimulate their economy and put people to work, they are willing to do that. Looking at the net inflows, and as you can see here, the countries that actually get the most inflow of foreign direct investment are the United States and China because they are the most attractive destinations. United States, obviously, because it's the richest country in the world, very successful, very stable, political system that supports their corporations and industries and businesses. China, on the other hand, growing. Lots of opportunities there for investors to come in a climate that, yes, it's authoritarian, but very much conducive to wanting these corporations to come into their country and work for their economy, and the authoritarian government will actually force people to comply with what they need them to do to get these corporations to come here into their country. The other countries that are fairly high recipients of foreign direct investment, these are the emerging markets such as Brazil, Russia, India, and then, of course, other high inflows, of course, would be other major developed companies like countries like Australia and France, UK, and, of course, Germany. I should have mentioned Germany earlier because they are also a very successful economic system that gets lots of investment coming into them as well. So the point here is that the countries that do not receive very much foreign direct investment, ironically, are the countries that need it the most. For example, the poor countries in Africa, and the main reason for that is that they are not politically stable enough to attract a corporation to want to come into their country. So we'll be talking about this quite a bit. For the rest of the class, we'll be touching on what are some of the major factors as to why poor countries stay poor, and the political instability is at the root of it. Now, the free flow of capital, that's what we talked about earlier, is foreign portfolio investment, and that includes cash, other types of stocks and bonds and savings and inflow of money, of assets that can be liquidized. Theoretically, this should be a stabilizing influence on economies because investors can shift according to the market where that investment needs to go. Markets can adjust in order to make that work. However, in reality, this liquidity that these types of assets have, this foreign portfolio investment, also has a destabilizing tendency because when problems arise, investors can run for cover, and it makes it easier for them to take that liquidized investment and move it somewhere else where they feel safer. And that could really hurt an emerging markets economy, that if they're depending, or if the banks have all these assets and then all of a sudden these assets are depleted and money, not as much money left to loan out to their economy, that could be potentially hurtful to their economy if investors are pulling out because they're skittish or something's going on. So that's why, even though it may sound stabilizing, doesn't necessarily work that way. And we're also seeing that the role of private businesses around the world is expanding relative to that of the state. As I've mentioned before, with the globalized capitalist system, it's the multinational corporations that are gaining more and more power. Speaking of which, the multinationals, they are based in a home state, such as the United States, which has the vast majority. Well, we're talking about U.S., France, Germany, U.K., Japan. They have the majority of the multinational corporations, but those corporations also go and operate in what we call the host states that I mentioned a minute ago. They have all kinds of types of services, industrial, financial, as I said, increasingly powerful from this globalized system that is not regulating them. The wealth of the largest multinational corporations exceeds that of most poor states. We see that the top 500 corporations in the world account for almost 1/2 of the entire world's gross national product. Apple, Microsoft, a few others have a combined about $500 billion in cash reserves. So it shows you how powerful a relatively small amount of these multinational corporations are. Just making a comparison here, when you look at the corporate revenue of certain companies and comparing them to the entire gross national income of an entire country, you can see what I'm talking about here. And these are from last year, but they don't fluctuate dramatically. Walmart, $395 billion corporate revenue annual, and the Austria annual gross national income comparable. So you can see these numbers here. Now, what we have to keep in mind, it's not necessarily a fair comparison because multinational corporations do not have the political power that states have, where states can mobilize armed forces and things like that and call on fiscal and monetary policy to make things happen. But as far as just pure wealth goes, you can see the comparisons. Toyota, for example, $204 billion in annual corporate revenue, and the entire country of Colombia has an annual gross national income of about that same amount. So that just gives you some interesting comparisons. Looking at multinationals and the foreign direct investment that they are responsible for, 89% of the 500 largest multinationals are based in the developed states. That's what I just mentioned a few minutes ago. The poorest countries of the world, this is LDC's least developed countries, their share of the world FDI has been increasing. Went from 8% of all the flows in 1990, 12% 2005, 18% 2010, a little bit higher than that now. But as you can see, they are the majority of the countries in the world, but they still only have about 1/5 of all the world foreign direct investment inflows. The OECD is the organization that was formed by the rich states of the world. I guess you could call it the Rich Countries Club. 35 members. They're responsible for a lot of coordination as far as the rich countries' policies, even tasked to do lots of studies that are useful to a globalized economy. The G8, the biggest 8 economies, biggest 8 states in the world, generate 60% of the world's gross national product. So that shows you kind of how lopsided our system is, in part due to human nature and in part due to the fundamental drivers of capitalism. So we'll be talking about that quite a bit throughout the rest of the course. More on multinationals and their host countries. These are the countries that are wanting them to come and invest in them. As I said, political stability, a major factor in choosing the host country. We'll get into the details of that more later, but the bottom line is if a state is unstable or if there's a military coup, they might just say, wait a minute, Mr. Goodyear, I'm going to have to expropriate your plant there, your rubber plant, because we need it for the war effort. So sorry about that. See you later. States could take ownership of those assets of the multinationals. So the multinationals are taking risks by doing this, and that's why their best targets are the countries that are politically stable. So you can see how that works. Conflict in a country could threaten the security of those assets. So multinational corporations do not really want to go build a billion-dollar plant in a country that's in the middle of a civil war. I mean, that's kind of a duh. Multinationals may funnel that investment into states that are also restricting imports that are coming from their home state. So as you can see, there's a lot of ironic consequences that could happen with this global system. We've already talked about how devaluing a currency could make imports more expensive, and that could also have an effect on the multinationals and their operation in that country. Effective government varies quite a bit. An effective government is going to provide rights and security and opportunities for its citizens, that sort of thing. But when you look at some interesting comparison polls, Guatemala, which is a poor country that has quite a high crime rate, and when you look at some of these just simple comparisons here as to corruption being a major constraint, 81% of Guatemalans say it is, only 2% in Germany. Lack of confidence in courts, strong lack of confidence in Guatemala, not much. In Germany, worried about the crime rate. Guatemala, which has a high crime rate, very high worry about that, not much worry in Germany. Now let's look at the multinationals a little bit more with respect to their home country, where they are operating out of. We see that multinationals can now relocate their headquarters or use shelters to lessen their taxation. So this is part of this unregulated global system that is becoming more and more advantageous for the multinational corporations, not for the countries. Google, for example, avoids approximately $2 billion a year in taxes by shifting revenues to Bermuda. Apple paid only an effective corporate tax rate of 1.9% on foreign profits of $37 billion in 2011, and it's actually decreased since then, down in almost a fraction of a percent. Apple also relocated their headquarters to Ireland so that they are in an effectively lower tax rate in the first place. And then the continued unregulated loopholes that enables them to... Now, again, I'm not doing this to point them out as being bad guys. I mean, this is rational behavior for them to do this. It's just that we do not have any corporate regulations on the global scene. Each country has its own regulations, so therefore these multinationals can kind of go out there and pick and choose and use their lobbying power, because they make a lot of money that they can invest in lobbying in order to try to get more tax breaks, get more advantages from government, as well as going out and picking and choosing what governments they want to work with. Sanctions, which we've touched on before, which is the most primary common go-to to punish another country. Well, if you have a multinational corporation operating in that state and you are sanctioning that state, well, you could hurt that multinational corporation as well. Generally, what we're seeing is that these multinational corporations that can now operate globally, they do not have much regard for the political preferences of their home government. What they want to do is maximize their profit to help, whether it's lobbying and campaign contributions or even just threatening to leave and take their business elsewhere. That's a possible thing they can do as well to influence corporate policy. So they have increasing influence on policy in their home state, while at the same time having less and less allegiance to their home state. So this is the wrap on global finance.